Hello, my name is Judah Yang, and I am a member of the Management Commentary Project team. Welcome to the third in our series of bite-sized webcasts on management commentary. In the first webcast, we discussed why the board is doing the project. In the second webcast, we explored why the board focused on the idea of value creation and what the board meant by it. In this webcast, I will be discussing why the board has proposed an objectives-based approach and how the board designed the objectives to help management tell their company's unique stories. I will first give a brief recap of the objectives-based approach and then answer some frequently asked questions. Before we dive into the disclosure objectives, let's first remind ourselves what problems the board is trying to solve in this project. As discussed in the first webcast, the board has identified shortcomings in current management commentary reporting practices. For instance, the information provided is often too generic, too short-term focused, and too fragmented. Also, the information provided often lacks balance and does not focus on matters that are important to companies' prospects. As a result, investors do not get the information they need. So it is addressing these gaps in practice and meeting global capital markets information needs that is at the heart of the board's project. To do so, the board set out to develop a management commentary framework that is flexible enough to enable preparers to tell their unique stories instead of providing boilerplate information, and at the same time is robust enough to provide an effective basis to regulators and auditors in assessing compliance. At the core of the board's proposals for such framework is an objectives-based approach. It includes an objective for management commentary as a whole, supported by a set of comprehensive disclosure objectives for each of 6 areas of content. The board proposes to set out all disclosure objectives as requirements. In other words, companies will need to provide information that satisfies all the disclosure objectives to claim compliance with the revised framework. So why has the board chosen an objectives-based approach? To meet investors' information needs, management commentary must focus on matters that are fundamental to the company's ability to create value and generate cash flows, and must provide material information about such matters. However, the range of matters that might be important for a company's prospects, as well as of the information that might be material, is very broad. Those matters and material information about those matters will be company-specific. For that reason, it would not be feasible for the board to provide a prescriptive list of disclosures that must be provided by all companies in all cases. Although it might be easier for companies to follow a prescriptive list of disclosures, such a checklist approach would not allow companies to tell their unique stories. A checklist approach would not necessarily capture all information that is material in the company's specific circumstances, and could also encourage a company to provide information that isn't material in its circumstances. So, a checklist approach will not address the existing shortcomings in current reporting practices. Instead, the board proposes an objective for management commentary as a whole, and disclosure objectives for each area of content. The disclosure objective aimed to provide clarity about investors' and creditors' information needs, and at the same time encourage management to apply judgment in determining what information would meet those needs. After all, when it comes to company-specific circumstances, the management of the company is in the best position to know what is fundamental to the company's prospects and what information is relevant to understanding those prospects. Disclosure objectives for each of the 6 areas of content comprise a headline objective, assessment objectives, and specific objectives. I'll use an example for the strategy content area to explain how disclosure objectives are intended to work. The headline objective summarizes the overall information needs of investors and creditors in relation to the area of content. In this case, for strategy, it is to provide information that enables investors and creditors to understand management's strategy for sustaining and developing their company's business model. Because this objective is defined at a high level, the board is also proposing assessment objectives and specific objectives to assist preparers in meeting this headline objective. The assessment objectives tell preparers what assessments investors and creditors are looking to make in relation to the area of content. Essentially, they explain why information needs to be provided. Note that the framework would not be asking preparers of management commentary to either anticipate investors' information needs or to predict how investors would use the information provided. Instead, the framework identifies investors' information needs based on the board's research in its project and asks preparers of management commentary to provide information that would satisfy the needs identified. So, in case of strategy, information shall provide a sufficient basis for investors and creditors to assess how effective the strategy is and management's ability to implement the strategy. Finally, the specific disclosure objectives describe investors' and creditors' specific information needs in relation to the area of content. Essentially, they tell preparers what broad topic information should cover. For strategy, this information covers the drivers of the strategy, including the opportunities management has chosen to pursue, the aims of the strategy, milestones on the path towards those aims, plans for reaching the milestones and achieving the aims, the financial resources required to implement the strategy and management's allocation of financial resources, and progress in implementing the strategy. To help stakeholders see how disclosure objectives all sit together, Chapter 11 of the exposure draft provides an overview of all disclosure objectives for all areas of content. As I have mentioned before, the board proposes to set out disclosure objectives as requirements. To support preparers in meeting disclosure objectives, the board proposes to include in the framework examples of information that might be material. It is important to emphasize that these examples are intended to help preparers identify the type of information that might be material. They are not intended to be used as a checklist. The examples can also provide a basis for challenge to auditors or regulators. The examples can all be found in Chapter 15 of the exposure draft. With this, let me turn to the questions we tend to hear about disclosure objectives. The first question is, why do we need 3 tiers of disclosure objectives for management commentary, especially given that in another exposure draft setting out a pilot approach for disclosure requirements in IFRS standards, the board is proposing 2 tiers of disclosure objectives. These 2-tier objectives for IFRS standards would include overall objective, which are equivalent to the headline objective in the proposed management commentary framework, and specific objectives, but no assessment objectives. Stakeholders ask why the board has also proposed a 3rd tier of assessment objectives for management commentary. They wonder whether the 3rd tier could add unnecessary complexity and be burdensome in practice. To answer this question, let's think again about the scope of information that management commentary might need to capture. As I have already mentioned, the scope of that information can be very broad, and it would not be feasible for the board to identify all types of information that might be material. Going back to my strategy example, investors and creditors would typically be interested in understanding the aims and drivers of management strategy, the milestones and plans for achieving those aims, the approach to capital allocation, and the progress implementation strategy. So this information would need to provide if material. However, what is really important is that investors and creditors ultimately need to assess in relation to an area of content. With respect to strategy, investors need to assess first whether management strategy is effective. In other words, is this a good strategy to pursue? And second, whether the strategy is achievable. But it is only management that can judge what information is material to those assessments, because that information depends on the company's specific circumstances. So the only way for the board to capture that information is by including assessment objectives. One final point to note. here is that the subject matter of management commentary is different from the subject matter of financial statements. Financial statements focus on a company's assets, liabilities, income, and expenses, and it is possible for the board to identify what information investors need about these items to support their assessments, and for IFRS standards to specify that information. In contrast, the range of matters discussed in management commentary is broader and indefinite. So the board needs additional tools to ensure that management commentary provides useful information that meets investors' and creditors' information needs. Finally, some people ask whether assessment objectives are intended to require management to make predictions, for example, about resilience of the company's business model or effectiveness of its strategy for developing that model. And the answer to this question is no. The board is not asking companies to make predictions, although companies may provide their own predictions or forecasts, and if they do, the proposed framework will tell them how to do so. What assessment objectives would require a company to do is to provide information that is needed for investors to make their own assessments, specified by the objectives, not to disclose the company's assessments. As I explained earlier, management best understand the business and would therefore be in the best position to determine what information would need to be disclosed to help investors and creditors make specific assessments. The board welcomes feedback on the proposals I've discussed today, and indeed on all aspects of the proposals in its exposure draft. The comment period ends on 23rd of November, and if you'd like to submit comments, you can do so via the Management Commentary project page on the IASB website. In the meantime, I hope this webcast has been helpful to you in understanding why the board chose an objectives-based approach to disclosures and how disclosure objectives could help companies tell their unique stories. Please join us for 2 further webcasts in this series, and for now, thank you for listening.